For the Chapter 8 tax return demonstration, we're going to be completing Comprehensive Problem 8.1. Our taxpayer is Trish Hempel, and she owns Hempel Retail, and we have her information here regarding her sales, expenses, and her cost of goods sold. We will complete a Schedule C for her business, and we'll spend a lot of time calculating the depreciation for her business assets. We were given this schedule of a fixed asset roll forward on the book basis. So we're going to use this information to calculate her tax depreciation for 2025. Trish earned wages, so she has a W-2, and she utilized a home office. So we're going to be completing Form 8829 to calculate her home office expense. We're not going to be completing the 1040 because the problem just didn't ask for it. So we'll only cover the Schedule C and the SE for self-employment, the 8829 for the home office expense, and the 4562 for depreciation. Of course, normally we would have to transfer all the tax and income figures from those forms over to the 1040 and to the Schedule 1, and you will have to do that on your tax return exam problem, so be prepared for that. I'm going to start with Schedule C. You'll see that I've already entered the information that was provided in the instructions just to save some time. We've got Trish's name and social security number at the top, her business profession, and the code from the instructions that best identifies her business or profession. The business name is Hempel Retail, and her employer ID number is listed here. It's said in the instructions that she uses the cash basis of accounting. She did materially participate in the operation of the business, so we clicked yes. It was not started in 2025, so we will not have to click here. She did make payments that would require her to complete a Form 1099, and on J it said yes, she did file the Forms 1099. We'll start with the gross receipts from the business. The information we needed for the Schedule C was given in the instructions, so I just transferred these figures over to the appropriate line. But I do want to go over this income section. Her gross receipts were $345,000, and she had returns of $14,000. So her net sales or net receipts were $331,000. Next, we had to calculate her cost of goods sold, and these figures are also provided in the instructions. You have to go over to page 2 to calculate the cost of goods sold. We were told that she uses the cost method to value her inventory, and there were no changes in determining quantities or values, so we'll click no on that. We were told the beginning inventory was $87,000 and that she purchased additional inventory of $100,000. She did not have any cost of labor, materials, or any other costs. So when we add what she started with the beginning inventory with what she purchased, she had $187,000 worth of inventory to sell to her customers. At the end of the year, she only had $72,000 left. So that means she sold to her customers $115,000 worth of merchandise. That was her cost. So she had $187,000 to sell. She either still has it or it got sold. So we know how much she still has, so we can calculate the amount that was sold. And the $115,000 cost of goods sold, we're going to just come back up here and enter on line 4. So for net sales were $331,000 and her cost of goods sold was $115,000, then her gross profit from those sales was $216,000. She had no other income, so we'll just bring the $216,000 down. As for the expenses, I have already entered those from the instructions. She had $6,000 in advertising, $2,500 in expenses, $5,000 in legal and professional, office expense of $800, rent for her other business property that were not vehicles, machinery, and equipment. This is probably a building, for $24,000, taxes and licenses of $5,000, utilities $2,000, and wages of $59,000. Now the figure that we need to work on calculating is this depreciation figure here. We'll take a look at the depreciation schedule that the bookkeeper provided. I've copied it into a spreadsheet so that we can see the depreciation calculations. Here we have a list of all of Trisha's assets. She purchased some in 23 and 24, and here are her current additions for 25. The depreciation, you'll see, has been calculated already, but it used the straight line method. This is depreciation for her books. So she's using a different depreciation method for her books than we need for tax purposes. The IRS requires taxpayers to use the Modified Accelerated Cost Recovery System, or MACRS, to calculate depreciation. So we're going to use the cost basis that was provided and complete the MACRS depreciation calculations over here for tax purposes. In the narrative, it said that for her 23 and 24 assets, she did not use bonus depreciation or Section 179. She just calculated the MACRS depreciation using the depreciation tables. So that's what we're going to have to do here. For the 2025 assets, she did decide to use the bonus depreciation. So if we look over here on the right, we're going to now calculate the depreciation for the cash register. The cash register was purchased in 2023, so that was year 1. For year 2, that was 2024, and we're now in year 2025, so that's year 3. So the basis is $9,500, and we need to go down to our table 8.2 for the half-year convention for 5-year property. And we're going to go down to year 3, over to 5-year property, and the percentage is 19.2%. So the $9,500 basis that we're given times the 19.2% will give us 2025 depreciation on the cash register of $1,824. Now we're going to move down to the 2024 assets. We have retail fixtures for $5,500. They have a useful life of 7 years, and we've got furniture with the basis of $4,200, also with a 7-year life. Now, what's important that we have to watch here is the acquisition dates. Notice that this piece of furniture was purchased in the last quarter of the year. So the last quarter is October, November, December. MACRS requires that we use the mid-quarter convention if over 40% of the assets acquired were acquired in the 4th quarter. So we've got a total of $9,700 in assets purchased. If we take the $4,200 and divide it by $9,700, that tells us that 43% of our assets purchased in 2024 were purchased in the fourth quarter. Since that is over the 40% limit, then we're going to have to use the mid-quarter convention table. In this table, right here, the IRS assumes that the assets were placed in service in the middle of the quarter that they were placed in service. In the half-year convention table that we used earlier, it's assumed that the asset was placed in service in the middle of the year, and all these percentages take that into account. So we just have to make sure we go to the right table. The first item was purchased in June. That's the second quarter. So January, February, March is the first quarter. April, May, June is the second quarter. So June 1st, the purchase was for $5,500, and it has a 7-year life. So we are going to come down to the mid-quarter convention table, and it is a 7-year item, and it was placed in service in the second quarter. And this is going to be for year 2 because they were purchased in 2024, that's year 1, and then this is year 2, 2025. So the percentage is 23.47% for the retail fixtures. So if we take the basis times the percentage, we'll get $1,290.85. Now we'll do the furniture. The furniture was $4,200. It was also a 7-year item, and it was placed in service in the fourth quarter. So if we go down to the mid-quarter table, fourth quarter, year 2, 7 years is 27.55%. So 4,200 times the 27.55% will give us 1157.10. So that's the calculation for the 23 assets purchased and the 24 assets purchased. So remember, for the 2025 assets, she elected to use the bonus depreciation. For 2025, the bonus depreciation is 100% of the item cost. For 2024, it was only 60% of the item, but the One Big Beautiful Bill raised it up to the full 100% for 2025. That just means that we are going to be able to go ahead and expense 100% of the cost of these assets, and that's a big benefit for taxes for a business. It really lowers the income. So here are the 2025 purchases, and when we add all those up, we get $52,000. So for the bonus depreciation, we didn't have to go to any tables. We just took 100% of what we paid, and we were allowed that deduction. So when you add up the cost of all the assets, you get the $52,000. Keep in mind that you cannot use Section 179 or the bonus depreciation on real estate. In the case of real estate, you'd have to go to the 27.5-year residential real property tables or the 39-year non-residential real property tables. So make a note of that, because those are the tables you're going to have to use for your tax return exam for Chapter 8. Down here in this little box, these are some additional figures that the problem asks you to calculate. We're not going to take the time to calculate all of those. So if you want to, you can just take a picture with your phone, and then you can fill in the blanks in the problem. Now let's move our figures over to our 4562. We're going to move the depreciation of 4272 over, and then the bonus depreciation of 52,000 over. The 4562 is where we show the details for the depreciation that we're taking. In Part 1, this is where Section 179 deductions are reported. We didn't have any Section 179 deductions because the bonus depreciation was much more advantageous for the taxpayer. Section 179 deductions can be limited by the company's taxable income, and then it also has annual limits, whereas the bonus depreciation doesn't have any of those limits. So when it is possible, taxpayers typically just take the bonus depreciation. In Part 2, it's for special depreciation allowances, or in other words, the bonus depreciation. So on line 14, we're going to enter our bonus depreciation, which was $52,000. Down here in Part 3, we're going to enter our MACRS depreciation. Line 17 is where the deduction for assets placed in service before the current tax year is listed. So that's where we're going to put this 4272, because this was for 2023 assets and 2024 assets. So we will put on line 17 the 4272. Now, if we had taken any MACRS depreciation for our 2025 assets, we would have identified that here. So 5-year assets would have been listed here with their basis, the recovery period, the convention, the depreciation method, and then the amount of the deduction. So there are 3 important sections on this form for our purposes this year. We're going to do line 14 with the bonus depreciation, line 17 for MACRS depreciation for assets that were placed in service before 2025, and then depreciation for items placed in service in the current tax year. So it's important that you know where each figure needs to go on this form. So now that we've got all our depreciation entered, we're going to bring our totals down to line 22. So we're going to add amounts from 12, 14, 17, and then lines 19 and 20. So we've only got the bonus depreciation and then the line 17 depreciation for items placed in service before 2025. So we will enter the total depreciation of $56,272. Now that we have our depreciation total, we can move it over to line 13 of the Schedule C. Now we're ready to add up all of our expenses. So when we add lines 8 through 27B, total expenses come out to be $160,572. When we subtract the expenses from the gross income, we get a tentative profit of $55,428. So now we're going to work on line 30, where it's reporting the expenses for the business use of your home. So we're going to have to attach Form 8829 to calculate that deduction. On the first part of Form 8829, they're asking for the percentage of your home that you used for business. So if we go back to our assignment, we'll see that it says Trish has a qualified home office of 250 square feet. Her home is 2,000 square feet. She purchased that home in 2020. and the basis in the home, which does not include land, is $200,000. The market value of the home, which is what she could sell it for now, what it's worth, is $250,000. And then we're given utilities, cleaning, insurance, and property taxes as the costs that she incurred related to her entire home. So let's get back over to our 8829. Number 1 asks for the area used regularly and exclusively for business. So if you claim a home office expense, you have to make sure that the area that you use is used 100% for your business. You can't have a bed in there. You can't have toys in there from your children. You've got to use it 100% exclusively for business. And we were told that she uses 250 square feet. We were told in the problem that the total area of her home was 2,000 square feet. So now we're going to get the percentage of her home that she uses for business. We're going to divide line 1 by line 2. When we do that, we get 12.5%. It's not a daycare facility, so we will not use lines 4, 5, or 6. So we'll bring our percentage down to line 7. Line 8 asks for the amount from Schedule C, line 29, and that's just our tentative profit from the Schedule C. So we've got the $55,428 entered there. Line 9 through 14 will not apply to us. I think that is for some special circumstances. On line 15, we're going to subtract line 14 from 8, and that would just bring the amount on line 8 down to line 15. On line 16 through 23, we're going to enter the amount of expenses for the home, for the entire home, that Trish had. And we were given some figures in the instructions, and so she had $5,000 in real estate taxes, $1,800 in insurance, $1,200 in utilities, $3,200 for $20 for repairs and maintenance, 21 line 21 is utilities, that's $3,200, and then the total is $11,200. So we're going to multiply this total by the amount on line 7. So line 7 is the percentage use of our home. So if she had total expenses of $11,200 and we multiply that times 12.5, we're going to get $1,400 as our deduction for these home expenses. This is the portion that's going toward the business use. So we don't have any carryover for 25, so we'll just enter the $1,400 down on line 26. And on 27, it's asking us to enter the smaller of line 15 or 26. 15 is our tentative profit, and so for the 1,400 is of course smaller. With the home office deduction, you cannot use it if you have a loss or to cause you to have a loss. On line 28, we're going to subtract line 27 from 15, and that'll give us $54,028. On line 30, we're going to enter the depreciation, but first we need to calculate that depreciation. And we're going to do that down here in part 3. So on line 37, enter the smaller of your home's adjusted basis, which we were told in the instructions was $200,000, or its fair market value, which was $250,000. So we're going to enter the basis. It's the smaller of the two figures, $200,000. There is no land included. It did not give us the value of the land. Remember, you can't depreciate land. So the basis of her home is the $200,000. The business basis of the building or the home is going to be this $200,000 times the 12.5% up here on line 7. So that is going to give us $25,000. And now we need to get our depreciation percentage. And to do that, we have got to go to our real estate tables, and those are included here in the assignment. Okay, we are looking for, this is business property. We're not depreciating, even though it's her home, we're not depreciating the residential real property. We're depreciating the non-residential business portion of her property. So we're going to come down to this 39-year table. She purchased the home in 2020, so that would be about the 5th year. So for recovery years 2 through 39, the amount, no matter what month it was placed in business, is 2.564. So that's going to be the percentage that we apply to the 25,000. When we multiply the 25,000, the business portion value of the home, times the percentage from the depreciation tables, our depreciation is $641, and it says to carry that to line 30 above. Okay, we have no carryover, so we're going to add lines 29 through 31 to bring down the 641. We're going to enter the smaller of 28 or 32, and that's the 641. And we're going to add lines 14, 27, and 33. So 14 is nothing, 27 is 1,400, and 33 is 641. So when we add that together for line 34, we get $2,041. There is no casualty loss to report. And then on line 36, we're going to actually get our allowable expense for the business use of the home, and that's $2,041. So we're going to carry that back over to Schedule C, line 30. So we'll put the $2,041. Now we can enter the net profit or loss. So if we subtract the $2,041 from our tentative profit of $55,428, we'll get $53,387 as our profit. Now this is her self-employment income, so we're going to have to take this over. We would take it over to Schedule 1 if we were completing that, and we're also going to take it over to Schedule SE, line 2. So on the Schedule SE, line 2, we're going to enter the $53,387. Let's make that a little larger. Okay, so on line 3, we're to combine 1A, B, and 2. So we don't have anything on the other lines. On line 4A, if line 3 is more than 0, multiply times 92.35%. And that will give us the 49,303. That's the amount we're going to apply the self-employment to. Okay, we don't have anything on B for the optional methods. We're going to combine 4A and B on C, bring down the 49,303. Okay, we don't have anything for 5A or 5B concerning church employment. So we'll just bring the 49,303 down to line 6. On line 7, we have a figure entered. That's our Social Security limit. And on 8A, we're going to total Social Security wages and tips. Total of boxes 3 and 7 on forms W-2. Remember, Trish did have some earned income and she had a W-2, so we need to see the amount in box 3 and 7. She doesn't have anything in 7, so $116,500. This is the amount of earnings on which she has already paid Social Security taxes. So we'll just bring that down to 8D. And then on 9, we're going to subtract 8D from 7. So 8D from line 7 will give us $59,600. We're going to multiply the smaller of line 6, her earnings, or line 9 by 12.4%. And that will give us $61.14 in Social Security taxes. We're going to multiply line 6 by 2.9 to get her Medicare tax of $14.30. So when we add 10 and 11, we have her self-employment tax of $7,544. Now we would move this over to Schedule 2 to report the additional tax, and now we're going to take half of that amount and we can report that as a 4 AGI deduction on her 1040. This represents the employer portion of her self-employment taxes. So that includes all the forms for this problem. And of all the schedules that we've worked on in this video for Chapter 8, make sure you are familiar with the 4562 and how to calculate depreciation. Remember where the bonus depreciation goes on line 14, and the depreciation for assets placed in service in tax years before 2025 go on line 17. And then if you have any depreciation on items acquired in 2025, it would go in the detailed section below. So if you have trouble with your depreciation calculations, or if you're not sure which tables to go to, please let me know and I'll be glad to help.